Hi, welcome to Numerix Video Blog. I'm your host, Jim Jocko. With me today, Vice President of Product Management, Udi Sella. Udi, how are you today?
Not too bad, thank you. Great to be here again.
Thank you. And joining us from our London office today, the man of the world, want to talk about to taper or not to taper and the ongoing, what has been categorized as schizophrenia by the U.S. Fed as it relates to the reduction of quantitative easing. Udi, perhaps you could take us a quick walk through and summarize really kind of what the crux of the recent Fed announcement is as it relates to starting the taper.
Yeah, certainly, Jim. So our story starts on May, when Fed Bernanke basically announced that the Fed might be slowing down the tapering rate, and instead of purchasing, I believe, 85 bonds worth of $85 billion a month, the Fed may reduce the pace. As a result, as soon as this came out, which was more or less mid-May, the first of all, the first thing that happened is that the yield on the 10-year note, the US 10-year note, went from 165 all the way to 3, almost 3 at the peak, 299. So that's a huge move in terms of price. So and the second thing is the reaction is that many emerging market currencies weakened. So just to give some examples, if we look at the dollar Brazil, went from 201 real for $1 all the way to 245 at the peak. The South African rand from 9 to 1031. The Indian rupee weakened massively from 54 rupees to a dollar to almost 69 rupees to a dollar, and so on and so on. And so basically what happened on the 21st of August is that, the Fed has like a bi-monthly committee. And the market was expecting that this tapering would start. So instead of buying 80 or 85 billion worth of bonds, the market expected something like 70 billion worth, in terms of dollars, of course, buying of bonds. So to slow down this QE3. And eventually, the Federal Reserve has decided not to taper. And then there was a significant relief reaction. So in other words, the US is still the center of the markets, and decisions that are being taken in the US impact the market globally, foreign exchange market, fixed income market, equities market, and so forth.
So you talked about some of the reactions within emerging markets. With this kind of reversal, have we seen a bounce back on those currencies?
Yes, we definitely have. But perhaps before that, it would be interesting to mention that the weakening in the respective emerging market currencies have been selective. So those economies with a huge trade gap, trade deficit, those economies, the local currencies, is weakened much more. So if we look at India as a good example, Indonesia, these are currencies that weakened a lot because the trade deficit is much larger. If we look at countries like Taiwan, the weakening was much less significant, or Mexico and so on. So this is, for instance, the current the deficit in India is about 5%, the trade deficit. Therefore, the market was very much concerned with the change, and the fact is that what people call hot money that went to higher paying currencies would go back to the U.S. And indeed, since the beginning of the year, we have actually quite amazing numbers. Till the end of August, $7.6 billion have been pulled from emerging markets. At the same time, 102 billion went into the US, 28 billion went into Japan, and this is with the Abenomics. And even Europe, had a positive inflow of 4.3 billion. So people basically were fleeing those emerging market currencies and actually going back into the more developed countries and economies.
So thinking back to a conversation we had on this video blog and around an article that you wrote back when we were looking at volatility of pairs and the development of double no touch options or reemergence of double touch no option type strategies because of the low volatility in these pairs, given this kind of new spikes because of the uncertainty around QE3, what should those in the FX world be thinking about today in terms of managing through these times of volatility and uncertainty?
So clearly, as long as there was this positive rally into emerging markets, this was very good for local importers. So let's say you're an Indian company and you're exposed to commodities. There was a great time to hedge the local exposure because typically commodities, the currency for commodities is the US dollar. That was a great level to hedge. Now, you also asked me about the relief rally. So there was some kind of I'd say that the market gave back 50% from the move up. So if the currencies, let's say, moved by 10%, the recovery was something like 5%. So now you, as a hedger, you should definitely consider hedging, the upside or the strengthening of the US dollar. And typically, options that could be used for that, I'm not sure that I would use a double knockout because it's not a full hedge, but you can definitely use options that we call like, so you buy a call option on the upside, a call USD dollar, with a knockout on the downside. So if there is a recovery, the option that you bought does knock out, but the overall premium is cheaper. So that's one thing. Now, if you're an exporter, you may want to use those levels because we're still at least on average 5 to 10% higher than the levels when Bernanke spoke first in May. Maybe these are good levels to lock your receivables, so actually hedge the downside. What we have seen a lot is that we see also investors looking at volatility as an asset class. So clearly, the volatility has increased in those emerging markets like Turkey or Brazil. And if you think that this was, for instance, you think that this spike in volatility and weakening of local currencies is gone, perhaps it's a good level to enter into a variance swap, or in other words, sell volatility. If you think that the U.S. is up to recovery and soon the yields will go up again, because I mentioned, by the way, that the yield went up to 3% on the 10-year U.S. note. Now it's down to 2.6.
Well, Udi, I want to thank you so much, and I want to come back to you in a few weeks if we can. Clearly, there's a lot of uncertainty going on right now in terms of the pending U.S. Potential shutdown. Markets are very tensive around that. Changes at the Fed in terms of tapering and QE3, as well as changes of the Fed leadership. So there's a lot to talk about. Clearly, a lot of implications within FX, and I'm definitely going to want to pick your brain going forward. And for those of you in the audience as well, we want to hear the questions and get to the questions you want. Feel free to follow us on Twitter at NX Analytics. This is something we're going to definitely be staying on top of. Udi, thank you so much for your time today.
Thank you for having me, Jim. That was a pleasure.
Always. And we'll talk to you soon.
Thank you. Bye.